Stop everything. It's Sunday, February 8th, 2026, 9:47 p.m. Eastern Time, and while you've been scrolling through your feed, something has been building in the global silver market that veteran institutional traders are calling the most compressed setup they've witnessed in 15 years. This isn't speculation. This isn't hype. What I'm about to walk you through is pattern recognition at the highest level, and if you don't understand what's converging right now, this very minute, you will wake up Monday morning to a market that has already moved without you. The last time we saw a technical structure this tight combined with this specific type of weekend geopolitical activity, silver didn't drift higher. It exploded. April 2011. Silver gapped 23% in 72 hours and never returned to those levels. The energy that's coiled into this current setup is larger. The fundamental backdrop is more severe, and the window you have to position correctly is now measured in hours, not days. Let me be completely transparent with you about what's happening right now while New York markets are dark. Silver closed Friday at $76.89 per ounce. Unremarkable on the surface. But in the final 90 minutes of Friday's session, something occurred that should have every single person watching this market paying attention. Volume in silver futures spiked to 340% above the 20-day average for that specific time window. But here's the part that matters. Price barely moved. When you see massive institutional scale volume with minimal price impact, you're watching one thing and one thing only. Sophisticated accumulation. Algorithms designed to build large positions without disturbing market structure. Retail traders don't accumulate like that. They panic buy. They chase breakouts. They create visible price disruption. Professional money does the opposite. They absorb every offer quietly, patiently, without moving the market. And they were doing it aggressively into Friday's close. Now ask yourself why. Why would institutional buyers with 40-year track records and billions in assets under management build positions into a weekend close? They don't do that for entertainment. They do it because their analysis or their information suggests something meaningful could develop while markets are closed. That's not speculation. That's how institutional positioning works. They don't take weekend risk unless the probability justifies it. That was signal one. But what's happening right now as I'm speaking to you on Sunday night is far more significant. While New York is closed, silver trades continuously on global exchanges. Shanghai, Tokyo, Singapore. These markets don't sleep. And right now, the Shanghai Gold Exchange is showing silver trading at a premium of 7.3% above Friday's New York close. Let me put that in perspective. At Friday's close, that premium was 2.1%. Normal weekend noise. By Saturday morning Shanghai time, it had expanded to 4.6%. Elevated, but not unprecedented. As of 2 hours ago, 7.3% and still widening. That means aggressive buying is occurring in Asian physical markets right now. Chinese industrial buyers, Indian dealers, Asian institutional funds, they're all bidding prices higher while Western markets sit dark. When premiums expand like this over a weekend, it creates a mathematical problem for Monday's New York Open. You cannot have silver trading at $82 in Shanghai and expect it to open at $77 in New York. Arbitrage doesn't allow it. The gap closes instantly through price adjustment. If this premium holds or expands further through tonight, New York will have no choice but to gap higher at the open. Not might gap higher, will gap higher. The only question is, how much? Now let me show you what most people won't discover until it's too late. The technical pattern that completed on Friday is something that happens maybe twice a decade if you're lucky. Silver has been building what technicians call an ascending triangle for 7 weeks. Each week, the price makes a higher low. Buyers stepping in more aggressively. Meanwhile, price keeps testing the same resistance level, $78.50. Friday was the 7th test of that resistance. 7 tests is extraordinarily high. Most patterns break after 3 to 5. When you see 7 tests, it means the supply of willing sellers at that level has been almost completely exhausted. Every weak holder who was going to panic and sell has already sold. What remains are strong hands, patient accumulators, and an enormous amount of what traders call coiled spring energy. Every failed breakout attempt adds energy to the pattern. The longer the consolidation, the more violent the eventual break. And Friday's close was 43 cents below that resistance, accompanied by that massive volume spike I mentioned. This is the final setup, the last compression before release. But technical patterns don't move markets by themselves. They need a catalyst. Which brings me to what's happening in Tokyo right now. There's a G7 finance ministers meeting that started Friday evening, US time, and continues through tonight. The public agenda is routine, currency coordination, economic stability, standard diplomatic language. But here's what isn't public. Sources with access to the preliminary session documents confirm there's a non-official agenda item focused explicitly on critical mineral supply chains and strategic resource security. Silver is named specifically alongside lithium, rare earths, and copper. when the finance ministers of the 7 largest economies on Earth convene weekend emergency sessions to discuss a specific commodity as a strategic concern that's not academic. That means they're seeing supply chain stress severe enough to warrant ministerial level attention. Think about what that means for Monday's open. While you've been enjoying your weekend, the most powerful economic policymakers in the world have been in closed-door sessions discussing silver as a national security issue. What do you think happens when that information becomes public Monday morning? If any statement emerges from this G7 meeting, even something vague about monitoring critical mineral markets, it will be interpreted by every algorithm, every commodity trading advisor, every industrial buyer as confirmation that governments see a supply problem significant enough to require intervention or stockpiling. That's not a catalyst that moves prices gradually. That's a catalyst that creates panic buying from industrial users who realize they may be competing with government purchasing. It triggers algorithmic momentum systems. It forces institutional investors who were waiting on the sidelines to enter immediately at whatever price the market offers. Let me show you what happened the last time we had this specific convergence. Late April 2011. Silver was trading around $48 going into Friday's close. Over that weekend, Asian markets showed aggressive premium expansion. Technical patterns were coiled, and rumors circulated, never confirmed but widely believed, that Chinese government entities were building strategic silver positions. Monday didn't open higher, it detonated. Silver opened at $49.80, up 3.75%, and kept climbing. Within 72 hours, it had touched $49.80 and was approaching the psychological $50 level. The point isn't that history repeats exactly. The point is that when technical compression aligns with fundamental catalysts over a weekend, Monday's opening can move so violently that most participants don't have time to respond rationally. They respond emotionally, and emotional decisions in volatile markets destroy capital. Now here's the piece almost nobody is watching. The options market is screaming. Options give traders the right to buy or sell silver at specific prices by specific dates. Looking at silver options expiring in the next 2 weeks, there's been absolutely massive accumulation of call options at strike prices far above current market. Specifically, $85 strikes, $90 strikes, and even $100 strikes. For context, silver closed Friday at $76.89. $100 strikes are 30% above current price. Under normal conditions, these are considered lottery tickets, low probability bets that almost never pay off. But the volume in these far out of the money calls increased 780% in just the final 2 days of this week. Someone with serious capital is betting that silver makes a massive move higher in the next 14 days. And they're doing it going into a weekend. That tells you they believe the catalyst could develop while markets are closed. Options traders deploying this kind of capital aren't gambling. They're positioning based on information, analysis, or conviction that gives them an edge. The fact that this is happening simultaneously with institutional accumulation, Asian premium expansion, and the G7 meeting creates a signal confluence that's exceptionally rare. You have less than 14 hours until markets reopen. Let me walk you through exactly what could unfold Monday morning, because understanding the range of possibilities is the only way to avoid emotional decisions. Scenario 1, orderly gap higher. Silver opens between $79 and $82, up 3 to 6%. This is driven by closing the arbitrage with Asian markets. Price consolidates at the new level throughout the day. The technical breakout plays out over subsequent sessions in more measured fashion. This is the least dramatic outcome. Scenario 2, explosive gap and continuation. Silver opens between $83 and $87, up 8 to 13%. The combination of Asian premium, technical breakout, and any G7 announcement creates immediate buying pressure. Algorithms trigger. Institutional confirmation buyers enter. Short sellers panic. Price continues rising throughout Monday, potentially reaching 90 to 95 by the close. This is what those options buyers are positioned for. Scenario 3, gap higher and violent reversal. Silver opens significantly higher, potentially 85 plus, but immediately triggers profit taking from those who positioned early. The gap exhausts buying pressure. Price reverses sharply, potentially closing Monday below Friday's level despite the higher open. This is the nightmare for momentum chasers. Scenario 4, no gap, continued consolidation. Asian premiums normalize overnight. No G7 announcement. Monday opens flat, and the pattern continues building energy. The breakout is delayed. Understanding these scenarios isn't about predicting which occurs. It's about ensuring your positioning is appropriate regardless of outcome. If you're already long physical silver or mining stocks, the gap scenarios create instant unrealized gains, but also the temptation to sell into strength prematurely. If you're unpositioned, gaps create the impossible choice of chasing price higher or waiting for a pullback that might never come. This is why having a plan before the open is critical. Decisions made in the moment in response to shocking price gaps are almost always the wrong decisions. Let's talk about mining stocks specifically, because this is where leverage becomes extraordinary. If silver gaps 10% higher Monday, quality silver miners will gap 25 to 40% higher in sympathy. But this leverage cuts both ways. If we get the gap and reversal scenario, miners will reverse even more violently. The beta to silver's movement is typically 2.5 to 4 times for mining equities. But here's what creates opportunity for those who understand market structure. Mining stocks are far less liquid than silver futures or ETFs. When they gap Monday morning, bid-ask spreads will be massive. The first trades often occur at prices that don't reflect fair value relative to silver's opening price. Professionals know this. They're already setting limit orders at specific prices below where they expect gaps to occur. While retail investors panic buy with market orders at the open, professionals will be selling to them at inflated prices. Don't be the liquidity provider. Don't chase opening gaps with market orders. Wait for the first hour volatility to settle. Set limit orders below the initial spike. Junior mining companies can gap 50% or more on opening volume surges, but those initial gap prices often represent the high of the day. Within an hour, prices frequently retrace 30 to 50% of the gap as early buyers lock profits and market makers establish rational spreads. Now, let me address the fundamental backdrop that makes this weekend uniquely significant beyond just technical and catalyst factors. Physical supply is genuinely constrained. This isn't theory. This is observable in delivery times, premium expansion, and inventory data. COMEX inventories, the physical silver available for delivery against New York futures contracts, have declined 23% since mid-2024. More critically, the ratio of registered inventory available for immediate delivery to total open interest representing delivery obligations has fallen to levels not seen since 2020. When this ratio becomes too compressed, it creates the possibility of a delivery squeeze. Contract holders demand physical delivery in quantities exceeding available registered inventory. The exchange must source additional metal at any price, or contract holders must roll positions to future months. Both outcomes drive prices higher. We're not in a full squeeze yet, but the preconditions are developing. If Monday brings a wave of new buying, particularly industrial users or institutions demanding physical delivery, it could accelerate the timeline for inventory stress dramatically. Shanghai inventories are even more stressed. Chinese warehouse stocks have declined 47% in 14 months. This is happening while Chinese industrial demand, especially from solar panel manufacturers, continues growing at double-digit annual rates. China produces roughly 80% of the world's solar panels. These manufacturers require silver for photovoltaic cells. It cannot be substituted without complete technology redesign. As Chinese inventories collapse while domestic demand surges, Chinese buyers must source from international markets. This is already happening. It's driving the Asian premium expansion we're seeing this weekend, and it represents structural demand that doesn't disappear when prices rise. Industrial users pay what they must to keep production running. Here's what smart money is doing right now while markets are closed. Professional commodity traders are reviewing positions. They're stress testing portfolios for various Monday scenarios. They're ensuring stop-loss orders are in place if they're short. They're ensuring capital is available to add to positions if the opening creates opportunity. And what they're not doing is ignoring the weekend because markets are closed. They understand the most significant moves develop when the majority isn't paying attention. Institutional funds are running scenario analysis. Risk systems are calculating potential profit and loss under different opening prices. They're preparing orders based on specific technical levels. Industrial users who need physical silver are contacting suppliers to check weekend prices and availability. The sophisticated ones are considering whether to secure supply Monday morning regardless of price. Anticipating availability could become severely constrained if bullish scenarios unfold. Central bank trading desks in Asia are monitoring Shanghai weekend action. They're communicating with Western counterparts about premium expansion. They're discussing whether coordinated intervention might be necessary if Monday creates disorderly conditions. All of this is happening right now, and most investors are completely unaware because they think closed markets mean nothing important is occurring. Let me be direct about risk management, because this is where investors fail regardless of whether analysis is correct. If you're long silver going into Monday and we get the explosive scenario, your immediate response will be euphoria followed by greed. You'll be tempted to add at higher prices, convinced the move is just starting. That's precisely when you need discipline. Major gaps often represent short-term exhaustion. Adding into vertical moves is usually wrong. The correct response is taking partial profits, tightening stops, and letting the remaining position run with protected capital. If you're unpositioned and we gap explosively, your response will be fear of missing out followed by panic buying. You'll hit market orders at the open, paying the worst prices of the day, then potentially suffering immediate reversal. The correct response is patience. Wait for opening volatility to settle. Wait for the first pullback. Use limit orders at prices you're comfortable with rather than chasing market orders into a gap. If we get gap and reversal, both positioned and unpositioned will experience emotional whipsaw. Positioned investors watch gains evaporate and are tempted to sell the bottom. Unpositioned become confused about buying the dip or avoiding chaos. The correct response is remembering that individual days, even dramatic ones, don't determine long-term outcomes. The thesis for silver is based on multi-year supply deficits and monetary dynamics that unfold over quarters and years, not single sessions. This is the critical distinction separating successful commodity investors from those destroyed by volatility. Monday matters. But it doesn't matter nearly as much as understanding the larger forces in motion and whether your positioning aligns with actual risk tolerance. Don't let one day's action, regardless of drama, override your understanding of what's building over months and years. Let me give you a framework for Monday that transcends immediate price. If Monday gaps significantly higher and holds, it suggests fundamental supply stress is more severe than even current prices reflect. It suggests institutional awareness is accelerating. It suggests we may be entering the acceleration phase of a move that plays out over months. In that case, Monday isn't the opportunity. Monday is confirmation. The opportunity already began, and those unpositioned will chase prices higher for weeks. If Monday opens unchanged despite weekend signals, it suggests the market is unaware of developing dynamics or choosing to ignore them temporarily. It suggests more time for patient accumulation. It suggests the eventual move may be larger because pressure will have built longer. In that case, Monday's lack of movement isn't evidence the thesis is wrong. It's evidence markets can remain unaware longer than seems logical, which creates the best opportunities for those with conviction. If Monday's gap fills in the first hour, it's bearish, suggesting false breakout. If the gap holds and price consolidates above it, that's bullish confirmation. Fourth, overseas response. If European markets show strong buying in European-listed miners and precious metal stocks, it confirms international participation. If European markets are muted, despite New York's gap, it suggests the move is primarily US-driven and potentially less sustainable. Here's what should keep you focused tonight. We're watching silver transition in real time from a sleepy, ignored commodity into a strategic resource governments and industries are racing to secure. That shift never happens smoothly. It comes in violent bursts that leave most investors confused and badly positioned. Monday could be one of those moments. One critical factor this weekend is cryptocurrency correlation. Over the past 18 months, silver has shown increasing alignment with Bitcoin during periods of monetary stress, not because they're the same asset, but because both are seen as alternatives to weakening fiat. Bitcoin's strong move this week signals momentum in the alternative asset trade. If it holds above 95,000 through tonight, that supports a strong silver open. If it breaks below 90, momentum may be fading, but Monday alone doesn't decide the story. What matters is what happens next. If silver gaps higher and holds those gains through Tuesday and Wednesday, it signals real acceptance of higher prices. That's how genuine breakouts are confirmed. If it spikes and fades back into the old range, it's likely a false move driven by temporary emotion. The same rule applies to mining stocks, only amplified. Big Monday gaps that consolidate often lead to major multi-month runs. Gaps that fail usually erase capital quickly. Discipline is everything. Right now, multiple signals are converging. Institutional accumulation, rising Asian premiums, strategic discussions at the G7 level, a coiled technical pattern near resistance, options traders positioning for volatility, physical supply tightening globally. This isn't about predicting one outcome. It's about preparation, understanding risk, knowing your limits, having a plan before emotion takes over. Markets reopen in less than 14 hours. Most people will show up Monday unprepared. You won't have that excuse. The setup is real. The window is now. When the bell rings, awareness will arrive suddenly and expensively for those who ignored it. Be ready.